Hey, it's Ryan Reynolds here from Mint Mobile. Now, I was looking for fun ways to tell you that Mint's offer of unlimited premium wireless for $15 a month is back. So I thought it would be fun if we made $15 bills. But it turns out that's very illegal. So there goes my big idea for the commercial. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. New customer offer for first 3 months only. Speed slow after 35 gigabytes if network's busy. Taxes and fees extra. See mintmobile.com.
Reality radio for a really great future. We're talking real money.
Here's the problem with not being prescient, with not having any truly predictive powers, not being able to tell you the future. Here's the problem. And we've mentioned this over and over again, but it bears repeating, particularly given a recent story, and that is we can tell you that we believe there's something wrong with an investment that sounds too good to be true. And yet we can't tell you exactly what that bad thing will be, what that negative that will impact these amazing investments in the future will be. But we're pretty sure that whenever somebody promises you high yields and low risk, that there will eventually be a catch. Well, hate to say we told you so, but we told you so. Yieldstreet, which was very popular, a lot of you called about it. They were promising high returns, low risk. Well, they're having problems.
Yeah, and you to get to Yieldstreet, by the way, I looked this up on Google Maps. You start on Assets Avenue, and then you make a left turn on BS Boulevard. And you end up right there at Yieldstreet.
And then then your money rolls down that hill and then ends up in the bay.
Yeah, that's pretty close. So this, anytime anybody says they're going to democratize something for you, they're going to bring it to you because
they're bringing, what was it? It was private money to the masses. Yeah,
absolutely. We're doing this. We're helping you out here because we want you to get the real treat that the 1% gets that you don't have access to. I always get a little nervous. You're right, and then you and I just talk about it, and we think, well, what could go wrong with this? Well, it turns out a lot of things could go wrong with this. And we got to give credit where credit's due because CNBC did a massive write-up about all this. And I remember them advertising on CNBC back in the day. So Yieldstreet, of 30 deals that CNBC reviewed, 4 have been declared total losses, which is shocking to me because
wait a
it's
minute.
real estate deal.
4 out of 30 deals. So that's like 12% of all of their assets or deals in the portfolio.
But it gets worse. 23 of them are deemed to be on the watch list as it seeks to recoup value for investors, sometimes by raising more funds from its members.
Okay, wait. Let me do the math
27
now.
out of 30.
Hold on. 7 are done for. No, 4 are done for.
Yep.
23 are in trouble. Doesn't that leave just 10% of them viable?
Thank you. Boy, your math is really on. You're really on it today.
I'm on this.
And
I have a calculator.
Told people was invest like the 1%. The ad talked about building wealth and diversity away from stocks and bonds, which, of course, we know had trouble back in, 2022, 2020. Well, bonds, of course, did well in 2020. But all those things. So this article, which I urge you to read if you have a temptation to do something as an alternative investment, and it's available free at CNBC. They talk about a few of the people that put money in. One guy works in the industry, put in $400,000 in 2 real estate projects. Each project had targeted annual returns of around 20%.
20%. What?
20%. And one was managed by a guy named Adam Neumann. Do you remember him?
Adam Neumann was WeWork, wasn't he?
And how did that all turn out?
I watched the documentary. It did not go well.
No, it did not.
And there were
well.
several. You're right.
The one that he oversaw has been declared a total loss, wiping out $300,000 of this gentleman's funds. The other one is trying to raise money to avoid a similar fate. And the guy says, there isn't a day that goes by without me saying, I can't believe what happened. I lost $400,000 in Yieldstreet. And this was taking money and investing in things like real estate, litigation proceeds, and private credit. Are they really
wait a
things you need in your
minute.
portfolio?
That sounds like something in the news lately, Tom.
Yes, it most decidedly does, because I think they're generally called alternative investments, private market investments, which, according to Yieldstreet, would provide both smoother sailing and the possibility of higher returns, passive income. So you don't have to do anything; you're just getting this money, and then
It's
it turned out
magic money. It's magical
it really
money.
is. $370 million into 30 real estate projects that have already recognized $78 million in defaults. 1 out of every $4 has already been defaulted on in some of these deals. And again, I give CNBC a lot of credit here. They dug into this in a lot of ways. But of course, the company is saying, well, wait, we faced extraordinary times here. Higher than expected interest rates, sort of lagging office market, right? Because people have failed to go back to, again, as you said at the outset, Don, you don't know what could go wrong. But when you promise things like a 20% potential return, passive income, and a return on your investments, wow, you should start being a little nervous about those things.
Yeah, it's funny. I was looking back through the Talking Real Money archives, and I found a show that we did back in March of 2022. It's a little over 3 years ago, right? And the title of it is Better Investments Rarely Are. And the summary says, we'd suggest you look both ways before stepping into Yieldstreet. Here's that discussion.
Give us your money. Modernize your portfolio away from the 60-40, and we will do wonderful things. We'll put it in art. We'll invest it in private credit. I think those are like loans. Real estate, private equity. How about this? How about having some of your money exposed to lawsuits? Because that's a great asset class, one that you shouldn't miss out on.
You buy the potential of a big settlement in a lawsuit.
Sure.
They have these mutual funds of sorts. They're not for just little people. You got to put at least $50,000 in,
and you have to be accredited.
And accredited.
In today's world is a silly
accredited.
thing. Yeah, right. Doesn't mean much.
And I'm not a wealthy person by any stretch of the imagination.
Anybody who has a home in the Seattle area for about 2 years is
you're
now
all
accredited. Yeah, pretty much.
But they sell this mutual fund of sorts that is, they have one that's in a little bit of everything. It's called their multi-class fund. And here's what they promise you on this. This multi-class fund has art in it, like Banksy. You can buy some Banksy.
Yeah.
Commercial paper, consumer debt, legal lawsuits, non-publicly traded real estate, non-publicly traded companies. And they promise you in writing, I love this, an 8% distribution rate.
Of some of the
8%.
gain?
Well, let me read
me
read the actual disclaimer. It says distribution rate 8%. Now, what do you think as a consumer when you read 8% distribution rate?
I'm making 8%.
per
Yeah,
year.
that's what people think. Yeah, of course.
That's good, isn't it? But you look at the little number 1, the superscript number 1 next to it, and it says quarterly distributions may exceed the fund's earnings, which may cause a portion of the fund's distributions to be a return of the money originally invested.
There was a guy who did stamps that way 100 years ago. His name was Ponzi. That's it. I mean, I'm not saying they're a Ponzi scheme, but returning cap or from the new. Anyway, it's risky. And they've been investigated not long ago by the Securities and Exchange Commission. Oh, I didn't even know the FBI part.
And the FBI over a scheme to somebody tricked them into buying some ships that didn't exist. And their management fee is, get this, 1.5%. So here's the downside. One, you don't know what you're going to make. Oh, and by the way, you only get liquidity if they want you to be able to get to your money. Oh, that's nice. This is a bad investment. That was an excerpt from our March 29th, 2022 episode. So we knew it would go bad. We just didn't know it would take this long.
Yeah, and here's what the CEO had said in 2020. Our mission at Yieldstreet is, how do we help create financial independence for millions of people? You do that by helping people generate consistent, passive income. In other words, give them your money, they're going to give you something back. And by the way, you're going to get an increase in the value of that investment as well.
Okay. Again, this is probably one of the most important lessons you can take away from talking real money. Really, this is the one you need to listen to. We talk about planning, and we talk about portfolio construction, and we talk about spending and retirement. But let me tell you, where the biggest issues come up is when investors start to believe what they're being told, that there are magical investments, that there are higher returns than the market or lower risk than the market with market-like returns. When you start hearing people promise you magical investments, I know you want, well, it's like, well, tell me what's wrong with it. Well, we don't know until it goes wrong. We know that there's something wrong because there's never, not to my memory, and you're almost as old as me.
Almost.
I don't ever remember one of these high-yielding, safe investments working out over the long run. They almost always end up failing.
And a couple of things here in addition to that, which I think is very good advice. Number one, when anything is sold as exclusive, limited, scarce, you got to get in this because that sort of thing. Remember, Bernie Madoff did the same. No, I'm not taking any new money. And this was a limited offer too, right? Because only a certain number of people can get into each one of these real estate projects. That should be always a red flag. And then the other reason that people bought this was for the returns. I don't think you shouldn't be running around saying, well, that one made more, that one made more. No, it goes back to what you just said a minute ago. You have a plan, you have a portfolio. You're not chasing things down that could make more than what you're in today. That we see as a real problem. And here's the other one, Don, that I find fascinating because you and I have talked about this a lot. The passive income aspect of things. People want to put their money in something and get paid back a certain amount with no risk and not have to do anything because you could buy apartment building, you could do all kinds of things, right? Or homes, you could create what you might want to call passive income, which certainly it's not because that's a business. But this is, I think, a trap where a lot of people said, well, I'm going to get all this payment for the rents, et cetera, and the value is going to grow. I love the idea of all that. It's just not as simple as it sounds. That's my worry.
No. It's not as. I think that's a huge understatement. Not as simple as it sounds. Here's what I want all of you. You should frame this and put it on your wall. Magical investments work right up until they don't. That is a fact. They work until they don't. And let's go back to my basic rule of financial physics. The first law of financial physics, spelled with an FY, is there are only 3 ways to make money: work, luck, or cheating. That's it. There is no fourth way. So you have to do, so passive income, it's an oxymoron. It's either work, luck, or cheating. Got it? One of those. You can't skip the work part. Well, you can. You can cheat, or you can just be lucky.
Yeah,
the work
and some
until
people
they
have done the other ones. I love the book, but by the way, if you call me, I'll get you a copy of the book. Because we just got a whole bunch more. So.
Oh, did you get them in? Oh,
yeah, we did. So anyway, because I love the book because it does go very carefully through many schemes people believe to be outside of those 3, and you really tell them no.
There aren't
the
any.
Ways, the tricks.
I have promised stuff to people over the past 2 decades. You show me another rule. Show me another thing that works that doesn't fit into one of those rules. And I had a whole library of books and I think money I threw in. It was nobody could find one.
I know. I love
No
it.
one
So,
ever has.
okay, but back to Yieldstreet. So this will be a story that we continue to watch. And exactly what you mentioned briefly, Don, maybe you understated, which would be something new for you, but the fact that this is back on the radar because, well, private investments, private credit, all that sort of thing is now being offered, bandied about as a potential place to invest in your 401k. And this is the reason I don't favor that for your retirement assets, period.
Again, you're understating. Don't favor it, hate it. That's me. You want me to
Well,
overstate?
hate is a very strong word.
I don't care. I absolutely hate the idea of you as individual smaller investors, unless you're like, I don't know, approaching billionaire status.
Yeah.
I am totally opposed to you putting any of your retirement money in private assets. I think the president is doing you a horrible disservice by pushing these things. And I think it's going to come back and bite you. Oh, yeah, once again, they're probably going to work right up until they don't. But these are terrible ideas. There's a reason why they were intended only for qualified investors. And even that doesn't mean as much as it
It's a
used
big fat
to.
joke because the numbers are the same as they were 20 years ago.
Yeah.
For accredited investors?
Yeah.
That's silly. So, all right. So listen carefully and save your money. They're those boring like stocks and bonds, right? That apparently have worked out for kind of a long time. Kevin writes us from San Carlos, California. I'll be retiring in June of 2026 with a pension that will cover our expenses. Well, that's congratulations. My tax bracket will not change and most likely will go down. During my career, I've also contributed to a 459B and have an excess of $1 million in it. We just writing to brag. Several years back when Roth became available, I adjusted all contributions to the Roth. Upon retirement, I will move my account from Voya, where it's now, to Schwab. In Schwab, I already have a Roth over 5 years old. Here are my intentions. Number one, start to convert traditional money to Roth at a pace that does not put me in a new tax bracket. Well, we like that. In other words, you know how much room you've got from your income to the top of the bracket. You're going to move the money from pre-tax to post-tax, pay the tax. I love that. Can I just add it to the existing Schwab Roth, or do I have to keep it in the existing Voya Roth that is almost 5 years old?
Well, no, you can move it into the Schwab Roth. That's fine. Roth is
Yeah.
a Roth is a Roth is a Roth.
But he does ask an interesting question to which I do not know the answer. Does each conversion start its own 5-year rule, or can
No.
any of the new money?
No.
Okay, so it is what it is then.
It is what it is. What it is.
And so it can come out at any time. You can move it over and then take it out with no penalty because you already paid the tax, right?
You already paid the tax, so it doesn't apply. Because you see, it's not a Roth contribution; it's a Roth conversion. So the
Good
5-year
point.
rule doesn't apply to conversions. However, I'm curious. Didn't he say he expected to be in a lower bracket
That's what he said.
in retirement?
Yeah, that's what he said.
Then why would you want to convert?
But he's in a lower bracket now since retiring.
Oh, since retired. But he
Since
said he
retired.
okay.
Yeah,
But he said he
correct.
expected to be in a lower bracket.
I think it just said tax bracket will not change and most likely will
go down.
Likely ever go down.
Wait. So read that to me
It's
again. I'm sorry.
awkward. My tax bracket will not change and most likely ever go down.
Oh, okay. I misheard.
Yeah.
I heard most likely go down.
Yeah. So
Okay, then yeah, that's fine. Yep, you're fine.
I'll be 63 when I retire. Most likely will not touch the main body of this account. Over the next 10 years, it could or could not grow substantially before our MDs. I know we can avoid taxes by donating to charities, which we will do, but taxes are paid. Money has time to recoup the expense of taxes. I will have options down the road. Thanks for the information. In other words, is a Roth conversion a good strategy? Yes. Are there limitations after you move the money? It sounds like no, because Don's used his friendly AI to make sure.
No,
that's
I did
the
that on
case.
my own, actually. this
Whoa,
time.
crazy.
Yeah.
You're really
No, I
going
did.
out here. And do I like it as an overall strategy? Yes. I would urge you to do it carefully and do it year by year. I think people just think blanket, I'm going to do it. I'd want to have the cash outside of the retirement account to pay for it as well. But anything you want to add there, Don?
Yeah, like everything else, we have these short, sweet little guides, and one of them is the answer is really it depends on Roth conversions. They're not always good. They're not always bad. They're good sometimes. And again, that's why I'm such a big fan of splitting the baby, having some in both.
Yeah, and I don't think you and I will be doing any conversions, right? Because we won't have time.
No, because all of my planning says lower income in retirement.
Yeah.
Lower
which
tax
is likely.
bracket. All of
but
mine
we're gonna
says
keep
lower
working,
tax bracket.
so you're going to be. There's not going to be time between the time you turn 73 anyway to do a whole lot.
Right,
you're still going to be contributing.
I'm going to be really old when I retire.
I just
I'm
stick with the
already
really old
old
thing. Yeah, DK writes us from Los Angeles. Hi, Tom and Don, regular listener to your podcast. Thanks for all you do to the community. Says to the community.
To the community.
Think that through. I don't think that through a little bit
I mean,
more.
you should follow Tom around on weekends and see what he's doing when he's not in the office.
I do a lot
It's
to the
scary
community
to
then
listen to
that's
the
not
community.
loved. My question is Roth versus pre-tax. 52
Oh, jeez, not again.
with $2 million in pre-tax. Since I'm in a high tax bracket and a high income tax state, California, all my retirement investments are pre-tax. I do not have a pension and would like to retire at 60. Plan to collect Social Security after 67. Given the big RMDs, required minimum distributions, I have to deal with, does it make sense for me to stop pre-tax altogether and do all my contributions in Roth going forward? He believes he'll have about $4 million in pre-tax by the time he retires at 60. He walks through some more.
Well, this will be
figures.
easy. Here's my answer. You ready?
Yeah, it depends. But he's already created a pretty sizable problem. I mean, I hate saying problem.
Excuse me.
You're going to have to take
That's
the money
a
out and pay
problem?
tax. I mean, he has a substantial amount saved, and he's going to have a substantial amount
Dude,
more if you get
wait a
market
minute.
growth. Yeah.
Would you rather have the $2 million and pay taxes?
Or have zero and not.
Right.
Or,
I mean, what kind of
50,000.
problem is this?
Fair enough.
We create these tax mountains out of these little tiny baby worm piles.
But what I was trying to get to is I don't know that I would add to that. I might just either split the baby, do part pre-tax and part post-tax, or just go to Roth, because then you're not piling on to the place where when you turn 75, you are going to see your bracket likely increase because your required minimum distributions are going to be sizable. If your figure of $4 million is, well, no, that's $4 million, he says, at age 60. So if you got another double in 15 years, which would not be out of the question,
No, it wouldn't
you
be.
could have $8 million, which the first year you got to take out 3.5%. Well, you can do the math. I mean, it's not an insignificant amount of money.
Okay.
But you got to pay tax on money you made. I get it. That's what you're saying.
So let's say you're not going to contribute to the tax deductible vehicles anymore, and you're just going to go Roth. And you're in a high tax bracket today, which you are.
Yep.
So therefore, you're going to lose. Well, it depends. Where does he live?
California. Los
This is the
Angeles.
California one. Okay.
Yep.
So you're going to lose over 30%.
Yep.
Of your contribution
That's
by not
right.
getting the tax deduction. So you lose at this end and you gain at the other end. Mm-hmm. This is one of those scenarios that absolutely requires some predictive tax planning.
I think that's fair.
Absolutely requires it. When you have that kind of money, you are no longer somebody who can just afford to wing it. You need a plan. Plans are critical once you have a lot of wealth.
To
There
get
you
a
go.
plan, what you're
Get a
saying.
plan,
Okay,
yeah.
just checking. All right.
Because you're not
Figure it
going to
out.
know. You're just not going to know.
That's fair. And by the way, even after the plan, I don't know that it'll be clear. I think it'll still be a bit gray because there's a lot of other things to consider too, tax rates into the future, a whole bunch of stuff. So, any rate, and speaking of that, if you'd like to talk to an advisor, you go to talkingrealmoney.com, click on Ask an Advisor.
Meet an advisor.
Oh, meet an advisor.
Why are we doing? Are we out of questions?
Well, no, but we're out of time because you say you're going to add some other stuff to this. I didn't want to run too long.
Well, I'm
so I
only going to
wanted
add
two
about
questions.
a minute.
Oh, that's it? Oh, come on. That was a pretty good show. I went back and listened to it.
No,
so
but
I
I
think you need to
was
add more to a minute.
No, I'm going to edit in some of that old show, but it was.
We'll
only
have a
gonna
bunch
be
of questions,
short
but they're for the next show. So
So this
I'm
was
out
just
of
going to be
questions.
short.
I guess your question was, am I out of questions? And the question is answered by saying, yes, I'm out of questions.
Are you hoarding them for when you have to do the Saturday show all by yourself?
I am not talking about that.
You
okay?
are. You're hoarding questions.
Leave me
He's
alone,
a question
man.
hoarder. Okay, I guess that in post-production, you guys are going to get a longer chunk of the Yieldstreet show we did in 2022 now.
Which is
apparently.
a great show. So I
was
think you should.
Did you listen to it?
No, I didn't listen to it, but I thought I'd say that. So I'm going to listen to it now, though.
So
'cause I
all
couldn't
we
believe how
got in
fast
the
you found it.
Q&A is like 2 Roth IRA questions?
Well, I liked them because they had the same theme. That's
They
all.
were the exact same question
They're
almost.
the same question. One
Well,
was
they were
from
very similar.
2 different people. So,
But the same thing, is it better to be in a Roth or a regular?
well, it's better to be in a Roth.
This is not going to go down in history as one of our better episodes.
I think it will because the topic is so critical.
The Yieldstreet thing?
Yes, I do. I think that's
You think so?
important.
You think the audience is going to be big for this one? All right.
I'll say huge without the huge aspect of it.
Without the huge. I'm going to vote the opposite. All right.
Of
So
course you
we're going
are.
to see
You
how that
always
works
do.
out. We're going to see how that works out when the statistics come in. And for now, we're going to end this because Tom decided arbitrarily
That's
to
enough.
withhold all the questions from the program to
Serving my
keep it from being
self-interest.
as interesting as it could have been. Thank you for listening, despite the boring nature of the Q&A section. If you have questions, go to talkingrealmoney.com, send them in. If you would like to call us on Saturdays, most of the time we're together. Sometimes we do a show alone when something else is going on. So give us a call on Saturdays, 3 to 5 p.m. Eastern Time at 855-935-TALK, 855-935-8255. And for now, we're going to be heading out of here prematurely, but we'll be back soon talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.